Money has always evolved, but rarely has it changed as quickly and quietly as it has over the past decade. There is a new financial reality unfolding, one that few people openly discuss. It is not just about inflation, rising interest rates, or stock market volatility. It is deeper than that. It is about how money behaves differently now compared to how it behaved for our parents and grandparents. It is about how the systems we trusted, retirement plans, stable careers, predictable returns, no longer operate the same way. The rules are shifting, and most people are still playing by the old playbook. Nobody talks about this new money reality because it challenges long-standing beliefs about safety, stability, and financial success. Today, we will talk about nobody talks about this new money reality. So, before we start, make sure to hit the like button and subscribe to my channel. One of the biggest parts of this new money reality is the silent erosion of purchasing power. Inflation is not just a temporary spike, it is a structural force that compounds over time. Even moderate inflation of 3% can cut purchasing power nearly in half over 25 years. This means that money sitting idle is not neutral, it is shrinking in real terms. Many people believe that if their bank balance remains stable, their wealth is preserved. But in reality, the cost of housing, healthcare, education, and food steadily rises. The new money reality demands growth, not just preservation. Interest rates have also redefined what safe means. For years, low rates encouraged borrowing and penalized saving. Now, higher rates affect mortgages, credit cards, and business loans. People who locked in low fixed rates benefited, while new borrowers face dramatically higher monthly costs. The lesson is that financial conditions can change quickly. A strategy that worked 5 years ago may not work today. This volatility has become part of the new normal. The labor market has transformed as well. Stable, lifelong careers with pensions have largely been replaced by job mobility, gig work, remote contracts, and entrepreneurship. Income streams are more fragmented. While this creates flexibility and opportunity, it also shifts responsibility onto individuals. Workers must now manage their own retirement savings, healthcare decisions, tax strategies, and skill development. The new money reality is one of personal accountability at a level previous generations did not experience. Retirement planning has changed dramatically. Programs like Social Security remain foundational, but demographic pressures create uncertainty. Fewer workers are supporting more retirees, and people are living longer than ever. That means retirement savings must stretch further. Depending solely on government benefits is risky, yet many households have not adjusted their savings rates to reflect longer life expectancy. The new reality is that retirement may last 25 to 35 years, requiring significantly larger financial cushions. Healthcare costs are another element rarely discussed openly. As people age, medical expenses typically rise faster than general inflation. Long-term care, prescription drugs, and specialized treatments can quickly deplete savings. Even those with insurance may face high out-of-pocket costs. In the new money reality, healthcare planning is not optional. It is central to financial security. Technology has also reshaped money itself. Digital payments, online banking, algorithm-driven investing, and financial apps have made transactions seamless. At the same time, they have introduced new vulnerabilities such as cybersecurity threats and fraud. The shift toward digital assets and cashless transactions changes how people think about spending. When money becomes less tangible, it can feel less real, sometimes encouraging overspending or impulsive financial decisions. Another under-discussed factor is asset concentration. Many households hold a large portion of their wealth in a single asset, usually their home. While real estate can appreciate over time, it is not guaranteed. Housing markets can stall or decline. Property taxes can increase and maintenance costs can escalate. Liquidity is limited, meaning wealth tied up in property cannot easily be accessed in emergencies without selling or borrowing. The new money reality requires diversification and liquidity awareness. Debt dynamics have evolved too. Student loans, credit card balances, and consumer financing have reached unprecedented levels in many economies. Easy access to credit creates short-term convenience but long-term vulnerability. Interest compounding works against borrowers just as powerfully as it works for investors. Managing debt strategically is more critical than ever, especially in higher interest rate environments. Another significant shift is the psychological side of money. Constant exposure to financial news, social media, and market updates can amplify fear and greed. Investors react emotionally to headlines, often buying high and selling low. The new money reality includes an information overload problem. Financial literacy must now include emotional discipline and critical thinking about sources of information. Tax strategies have also become more complex. Retirement accounts, taxable brokerage accounts, and tax-free vehicles must be balanced carefully. Future tax rates are uncertain, and policy changes can alter long-term plans. Individuals must think about not just how much they save, but where they save it, and how withdrawals will be taxed later. Tax diversification is emerging as a critical concept. Longevity is perhaps the most transformative factor of all. Living longer is a gift, but it comes with financial implications. A retirement lasting 3 decades requires not only savings, but sustainable withdrawal strategies. Sequence of returns risk, where early retirement market downturns permanently reduce portfolio sustainability, has become a major planning consideration. Traditional rules of thumb may not hold under modern longevity assumptions. The global economy has added another layer of complexity. Supply chain disruptions, geopolitical tensions, and interconnected markets mean that events in one part of the world can quickly affect another. Economic shocks travel faster than ever. This interconnectedness makes diversification across regions and asset classes increasingly important. Education costs represent yet another aspect of this new money reality. Tuition inflation often outpaces general inflation, and student debt burdens can delay homeownership, investing, and family formation. Families must now plan for education funding earlier and more strategically than before. Entrepreneurship and side income streams are becoming essential for many households. Relying on a single income source can be risky in uncertain economic times. Multiple streams of income, investments, freelance work, rental properties, or business ownership provide resilience. The new money reality rewards adaptability and skill diversification. Inflation-adjusted wage growth has not always kept pace with rising living costs. Even when salaries increase nominally, real purchasing power may stagnate. This creates pressure on households to save more aggressively or invest more effectively just to maintain the same standard of living. Another rarely discussed truth is that financial independence requires a mindset shift. Saving alone is insufficient. Strategic investing, continuous learning, adaptability, and periodic reassessment are necessary. The financial world is dynamic, not static. Plans must evolve as economic conditions shift. Ultimately, nobody talks enough about how personal responsibility has intensified. Previous generations relied more heavily on defined benefit pensions and predictable economic growth. Today, individuals must build their own safety nets. Emergency funds, diversified investments, adequate insurance coverage, healthcare planning, and realistic retirement projections are not luxuries. They are necessities. The new money reality is not meant to create fear, but awareness. By recognizing these structural shifts, persistent inflation, longer lifespans, digital transformation, demographic pressures, evolving labor markets, and global interconnectedness, individuals can prepare proactively rather than react defensively. Financial security today is about flexibility. It is about building systems that can withstand volatility. It is about understanding that safety is not the absence of risk, but the management of it. The conversation needs to move beyond outdated assumptions and toward practical adaptation. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.